right now you have kind of like that meme with Clint Eastwood and the other cowboys like looking at each other, and they're all kind of looking at each other, waiting for somebody to draw first. That's what it's like in the spot market right now. We're looking at north of 150 companies that have something to do with uranium now. 2 years ago it was 60. At this point, I mean, it sounds kind of crazy to say it, but I don't even think we need Sprott to buy any more uranium. I think the heavy lifting's been done, and the demands from the sector are going to continue to move things higher.
Hey guys, welcome to Capital Cosm. Today I have a very special returning guest on the show, a regular, Mr. Justin Huhn, the Uranium Insider. Justin, thank you so much for coming back on.
My pleasure. Yeah, good to see you again, Danny. How are you?
Pretty good, pretty good. A lot of people have uranium on their minds, and we got Dr. Uranium himself here to answer your questions. Just last week, I asked my ex community, Twitter community, if you want to call it that, whatever you want to call it, to submit their questions. So if you don't follow me on X, be sure to do so. I do, pose some of these question submissions from time to time. So if you want to submit your questions to any guests down the line, be sure to follow me on X. But we do have a list of questions from the Uranium family on Twitter that Justin will be is more than happy to answer. And with that said, you guys, as always, nothing in this video is financial advice. Neither Justin nor I are financial advisors, so please do your own due diligence. And with that said, Justin, let's go ahead and kick things off. Let's just get your take on the general view that you have on the uranium market at this very minute.
Sure. I would say at this very minute, I think this is a really boring moment in time for the market. And of course, there's always news flow that is interesting, and there's a very exciting, promising future for nuclear energy and for this trade as well, for uranium. But in this moment in time, it's been very boring. It's been very boring for the last week and a half. And sometimes investments are just boring, and that's okay. I know that uranium investors are very passionate creatures and often want a moonshot as soon as possible, or want the next catalyst to come right away, and it doesn't always work like that. So I think right now we're just kind of sorting through a little bit of a boring market. And I think what's happening right now in terms of the industry is trying to digest where this market is currently and what the heck just happened. So what just happened was the price of spot uranium essentially doubled in about 5 months' time, actually in about 4 months' time, which historically speaking is an incredibly sharp move to the upside. The interesting thing that they're trying to digest here is that this didn't happen because Sprott was in the market buying millions and millions of pounds of uranium. And that's exactly what happened in the previous two price spikes. So in the autumn of 2021, March, April of 2022, Sprott, there's a lot of capital flowing into the sector, a lot of capital flowing into the Sprott Physical Uranium Trust. Sprott was in the market buying a lot of uranium. That moved the price substantially, 10, 15 bucks a pound. And then the price basically settled right back down. And that happened twice. And that's what was driving that price rise. Now, bring us to the present moment in the last few months. And the price went from 50 bucks to $107 from August to just last month. And that wasn't driven by Sprott. Yes, Sprott was in there buying a few 100,000 pounds, a couple 100,000 pounds a month since September. It's not nothing, but it's certainly not volumes that would justify a doubling in the price. So what exactly is going on here? Well, we have a historically tight spot market where there's a very clear rising price trend for the commodity, and everyone that's holding on to pounds here is holding on to them more tightly, with few exceptions. One of those exceptions would be traders. Traders are trading pounds back and forth all the time, and this is the type of market that they absolutely love. So that's currently happening, but the utilities are trying to take stock of this moment. And what they're being told by their advisory services like Trade Tech, like UXC, is basically, hey guys, this time it's for real. we don't see any supply savior coming, and we don't see any reason to believe that we're going to see lower prices anytime soon. That's the messaging that they're getting from the entities that up until the last year, year and a half have been telling them basically, the price is in an uptrend, but there's still plenty of supply out there. And now that has shifted, and now the messaging is clear, even from these historically very conservative entities who have the nuclear utilities as their clientele. The messaging from them is clear. Time to step up, boys. This is not about to go back down. And so now we have this moment where there's kind of a stalemate in the market. The markets are kind of risk off right now. So Sput's not about to do any buying. So there's not any preemptive trading around expectation of them buying, which you can sometimes see. And utilities are just kind of on the sidelines, trying to take stock of this moment and figure out a way forward. And the way forward is for them to buy and to recognize that this pricing environment is going to remain here, and it's going to remain with pressure to the upside. So just kind of a holding pattern here for the moment. We expect very, very large moves for the commodity this year and beyond. And we expect we're going to see evidence of some utilities and probably some larger utilities stepping up to the plate, signing very high price contracts. And any surprises that come along are going to lead to some volume in the spot market, where utilities typically don't procure a lot of their uranium. A small amount of uranium is purchased in the spot market by utilities. Then you have traders, you have financials, and you even have producing companies buying in the spot market, which was a decent amount of volume last year, actually. So right now, you have kind of like that meme with Clint Eastwood and the other cowboys like looking at each other, and they're all kind of looking at each other, waiting for somebody to draw first. That's what it's like in the spot market right now. And so it's just going to be there for a minute until it's not. And there could be a catalyst at any point that moves things, or it's a utility that has to cover that just can't figure out how to do it at lower prices, and they're just going to come in and do it. And we're going to see pressure to the upside. That's what we expect. Any dips here in the spot price, even a couple of dollars here, if we get down below $100 a pound, we expect that we're going to see buyers step in and start purchasing uranium. That's what happened a couple of weeks back when it made that similar dip.
Okay, so it's a very tense moment right now in the uranium space, kind of like the eye of the storm, what you would say.
I don't know if tense is necessarily the right word, because you don't have a lot of preoccupation by fuel buyers and nuclear utilities. They're not obsessed with the price like we are as investors. So we tend to put an incredible amount of weight on where the commodity is going, and for good reason, right? The equities, generally speaking, will follow the trajectory of the commodity. For nuclear utilities and fuel buyers, basically, they buy uranium when they have to buy uranium. And it's not necessarily even that much dictated by the price. Yes, they don't like to pay higher prices. That is true. Yes, it affects their bottom line, but they can't not buy fuel. They can't have their reactor actually go unfueled. And we're not about to see that, by the way. There's not like this impending panic moment that the investors seem to be praying for all the time. There's just this shifting dynamic where it takes a long time for a sector that has seen low priced, abundant material for a decade, all of a sudden to shift to this environment where they can't buy 200,000 pounds in the spot market without moving the price up. And if they call up Cameco or Kazatomprom or Orano, and they want to get filled for material in 2026, 2027, they say, sorry, guys, we don't have any. I mean, that's a new environment, and it takes time for the sector to digest that. And we're going to see multiple periods like this where something, whether it's just straight up momentum, or it's capital markets going risk on and the financials buying, or it's an unexpected life extension and the nuclear utility has to come in for near term pounds. We're going to see sharper moves to the upside to the point where it cools off for a minute and then it consolidates. And I just think that's how this bull market is going to be. It's going to be this series of bull pennants where it's going to be this move up that's very sharp, and then it's going to chop sideways to down, and it's going to move up, chop sideways to down, until and unless we see evidence of increasing supply and motivated selling coming into the spot market.
Yeah, and that's actually how it's kind of played out as well. I mean, the rise from $20 to $100, you did see those sharp rises and those sideways pennants, like you mentioned. So, okay, sounds good. Well, let's go ahead and get to our first question here. This one is from John Leggett. I interviewed John not too long ago. If you haven't seen it,
I did watch it. That was great. Yeah, John was awesome.
Yeah. So
Good
John
interview.
is big shout out to him. His question is, what's the latest with Somer? Is Orano producing in stockpiling pounds for when the port in Benin reopens, or are they on carrying maintenance due to the broken supply chain?
It does seem like they haven't necessarily halted their actual mine development and extraction of ore. What has been problematic is both the importing of reagents to process that ore, and to my knowledge, they haven't been able to export uranium out of the country essentially since the coup. Perhaps there was a shipment or two right after the coup, but it's been multiple months, and that was obviously reflected in their reporting for 2023. Their production was off 60% from Somer for last year, which is quite a lot considering that the coup happened in the seventh month of the year to be off 60%. But anyhow, they did highlight in their reporting that they have been working on alternative routes for importing those reagents. They didn't specify about exporting uranium. But our take at this point is that things are still a little bit complicated, but it's possible that they'll be improving. So there's been whispers over the past couple of days that ECOWAS, which I don't remember what the acronym stands for, but it's basically the consortium of the countries in that area, right? The Southern Saharan countries. They have been placing the sanctions on Niger after the coup, and those sanctions are what have been affecting the importing and exporting across the border. So if those sanctions are lifted by this consortium, by ECOWAS, then we would likely will see an easier process of both importing those reagents again and potentially exporting uranium. Now, I can't really speak to the negative sentiment towards the French in Niger and how that may affect their future doing business and mining in the country going forward, aside from the issues of the coup or importing, exporting. Can't really speak to that, but it looks like it's improving, but it doesn't really look like the coast is yet clear.
Got it. Next question we have is from Mike Gold. He says, we have heard a lot about more physical funds coming into the market, but not much news on them lately. Are they still coming? And is there even enough in the spot market for them to buy?
They seem to be shrouded in mystery at this point, and I basically take their disappearance as evidence that it's just the market is just too thin, and there's not a lot of material to buy there. So, no updates at all from ANU Energy, which was going to be based in Kazakhstan. They did do that initial, I think it was a $74 million raise. I believe they bought some uranium with that money, but that was probably a year and a half ago. As far as we can tell, the IPO that was scheduled for Q2 of this year is not happening, and the follow-on raises are not happening. Same goes with PFYN. There was the Singapore-based fund that listened to an interview recently with Askar Badarbayev, who's a strategic advisor for that fund. They also are not being clear on exactly what's happening, whether or not they are going to be publicly listed, whether or not they are going to be able to raise money to buy uranium. So both of these funds that last year we were all expecting would arrive and do some purchasing in the market seem to have gone quiet. But that's totally fine. We don't need them at this point. I mean, it sounds kind of crazy to say it, but I don't even think we need Sprott to buy any more uranium. I think the heavy lifting's been done, and the demands from the sector are going to continue to move things higher. We don't need the funds to buy uranium, but there is still certainly a decent amount of financialization of the sector. Not only Sprott and Yellowcake buying uranium, Sprott sometimes on a monthly basis, Yellowcake on an annual basis, but also individual hedge funds participating and purchasing and holding physical. And to our understanding, actually, in some cases, trading it or not trading it like spot market trading it, but having forward commitments, almost acting as carry traders and signing some shorter and midterm contracts with the end users. So which is a really interesting point, because if I can continue on with this point and ramble on, the previous bull market, the spike that happened was largely driven by financials, and the fall that happened following that spike was largely driven by those financials dumping those pounds back into the market. It was their buying pushed it up, their buying brought it back down. And so if the volumes that we're looking at that are being held by hedge funds, if a certain amount of those volumes are committed to forward deliveries for utilities, which our understanding is that that's the case, then there's going to be less selling pressure when that time comes, when the hedge funds are wanting to de-risk, get those pounds off their books, whether that's to take some risk off in a declining bear market, or whether they feel that the move in uranium is over. Either way, we're going to see some selling from these financial entities eventually. But as long as the bulk of those pounds are committed, that should be less selling pressure when that does eventually happen.
Do you have any idea on how, in terms of how many pounds they've already scooped up?
Are you talking about the hedge funds specifically?
Oh no, sorry. These financial
Sprott?
vehicles.
Well, Sprott specifically is holding 63 million pounds off the top of my
Mm-hmm.
head. They purchased, I think, 43 million pounds since taking over Uranium Participation Corporation. Yellowcake can purchase $100 million per year. I can't remember off the top of my head how much they hold. I think it's just under 20 million pounds of uranium that Yellowcake holds. So it's a decent amount that the funds are holding.
Gotcha. All right. Next question is from that uranium guy. He asks, he would like to have your take on the 2+ year underperformance of uranium equities when assessing the URNM to uranium spot price ratio. So he's basically asking why the equities haven't really kept up with the metal.
Well, I mean, the short answer is there hasn't been enough capital flow into the equities. I mean, I think that's the easy answer. The spot price itself is driven by the industry. And in some cases, with the spikes that we've seen and the tightening of the market has certainly been aided by the purchasing from Sprott, which is driven by capital markets. But really, on balance, the move from the bottom of the bear market to where we are now is being driven by the fundamentals of the sector. So the commodity is going to do what it's going to do based on the demands of the industry. The equities are still stocks, and stocks do what stocks do. They don't always precisely follow that. So we've seen the industry rise in market capitalization. A lot of that has to do with the number of companies that are now present. We're looking at north of 150 companies that have something to do with uranium now. 2 years ago, it was 60. So the number of companies that have shown up or changed their name to XYZ Uranium has grown a lot. So the market capitalization here is about 70, maybe about 70 billion total. If you take out Cameco and Kazatomprom, it's a little bit more than half of that is or almost half of that gets chopped off with those two companies. So the sector hasn't really grown that much in terms of capital flows. Why is that? Well, in some cases, or in many cases, the big money that can actually position still needs the sector to grow in size in order to do so. So there's some growing pains here, and for whatever reason, the retail crowd has not been overly enthusiastic, and I think that there's a bit of momentum in terms of hindsight bias and the experiences of retail investors in this sector, especially if you haven't been here for a very long time. So if you showed up in the sector in the last 2 years, you've had the rug pulled 3, 4, 5 times on you. You've gone through some volatile times. So anytime it moves up, you have a certain percentage of the retail crowd go, okay, I'm out. I made my money back, I'm out. Or I'm up a little bit, I'm out. This is just going to get rug pulled again, I'm out. So for whatever reason, we've yet to really see that frothed up, enthusiastic sentiment in the sector, even here at $100 a pound. With all of that said, $100 a pound is not as high as it sounds. If you go to inflation adjusted previous price spikes, we've gone way, way higher. $134 in 2007 is $200 now. And that spike was driven by a couple months of financials buying and in some participation from the industry, but primarily financials. So this is a long game. And generally speaking, I know what chart he's talking about. You're charting the equities against the commodity. That could go dead flat like an EKG, straight sideways, and we're going to be happy campers because the commodity is going to keep moving higher. But really, I don't have a great answer of why the equities aren't higher here, other than we haven't seen that super enthusiastic and persistent positive sentiment that I believe the sector actually deserves. I think what has influenced this sector and has influenced other sectors as well over the past 12 to 18 months, let's say, is the And it's tapering off now because the bears have been absolutely smoked in the broad market by, the S&P just climbing a wall of worry and just crushing the shorts. Last year, and to some extent, the second half of the previous year was an absolute fever pitch of here comes the bear market, here comes the hard landing. Black Monday Part 2 is just around the corner. I mean, I guarantee you that is 100% affected sentiment and kept people out of all markets or kept their allocation into any market lower than it would have been. So that overall just negativity that is across markets certainly has affected our sector as well. So that's my best answer, I think, for that. And there's also evidence that we've seen, let's say, smart money or institutional money has been accumulating and positioning in the sector. And so if you look at it that way, barring a couple moments of retail frenzy, autumn 2021, spring 2022, this could still be sort of the tail end of that first leg. Like that's how early this really could still be. Institutional money coming in first, and they're buying what they can. That's why what they can buy has outperformed Cameco, Sprott Physical Uranium Trust, Paladin, NextGen,
Yep.
the ETFs, right? To some extent, the ETFs, they see a little bit more liquidity, more retail ownership, but that's what you can buy. That's what's liquid enough. And that's what is outperformed. And that also is typically what outperforms in a resource bull market. Leg one is smart money positioning and outperformance of the large caps. That's literally what we have just witnessed.
Yeah, I mean, we've looked at the various charts kind of depicting what you just described there. Number one, institutional money flowing into URA, URNM, Cameco. What you'll notice is for the last 2 years or so, when the price was consolidating down with these ETFs, institutional ownership was moving on up. In addition to when the price started moving up themselves by virtue of Cameco, by virtue of URA, you started seeing more institutional investing coming in. And so you look at also things like Google Trends data. If you add in like uranium stocks, the volume of search queries for uranium stocks is actually a quarter of what it was in 2021. So
there you go.
That tells me this big rise that we've enjoyed over the last several months in the uranium price or in the equities, let's say, was precipitated by institutional ownership, not really by retail. Retail hasn't really touched this thing all that much in the last year and a half. That's my takeaway from it all.
Yeah, I think you're absolutely right, Danny. Another thing I should point out is that I think that in the same way that the industry is trying to take stock of this moment in time, I think that investors naturally, because nobody can predict the future, are always trying to look to the past to understand what they might be able to expect going forward. So if you're looking at the past, whether that's the last couple of price spikes that were spot driven, or if you're looking at the previous bull market, everyone is expecting a rug pull. And we're going to have these moments where, just like the utilities, see a price spike from $50 to $107 and they're waiting it to drop back down to 65. When that eventually doesn't happen, then we move higher and they accept their fate and they accept the market that we are presently in. And I think the same thing is going to happen for the equities. Every single time we see a rise, we're going to see technical traders taking profits, all good, makes a market. And we're going to see retail say, okay, that was it, I'm out. And that's just going to keep happening, rinse and repeat over and over. And it's perfectly fine with me. I don't really care. This is a long-term investment for me. And I don't know how long it's going to last. We could see a spiking price driven by financials still. That could happen next week. And it could spike and it could come back down to a price that the industry needs, or that the industry is willing to work with, which right now is $100 a pound, with term contracts $20, $30 higher, with ceilings, around that price, and potentially some term contracts lacking in ceilings. Like that's where the price is going. But the equities market's going to act like what it does, and we're going to see profit taking along the way, and it's all good. One more point I would make is that most stocks in the space have a very different denominator now than they had in 2021 or 2022, which is the outstanding share count. So while the charts might not reflect that the companies have grown, their market capitalizations have, generally speaking. So if you see, oh, this stock hasn't moved, and in 2021, uranium was at $50 and now it's at 100, what gives? Well, the outstanding share count has grown by 30%. So it's something like that. It's most companies in the space have a different denominator than they did a couple of years back, and that's just the nature of pre-cash flow, mining stocks. They have to raise money through equity.
Yeah, yeah. Just really quick before we move on to the next question, I've actually got the chart pulled up here. Wanted to show you. So we've basically got uranium stocks, the search term uranium stocks. And this is pulling in Google Trends data. This essentially looks at the volume of search queries for uranium stocks. What you'll notice is this was back in 2021, summer of 2021, when we enjoyed that huge rise to the top. And this is where we're at today. So you can clearly see, even though we've seen a decent swing up in the equities price and the sector in and of itself, it doesn't appear that it was precipitated by the likes of retail, who would leverage something like Google to figure out what stocks they want to buy. It's not even anywhere close to, let's say, 2007, where this was 20 years ago, just about, when internet adoption was just a fraction of what it is today.
Wow. That's a very, very striking chart.
Yeah. So index against the highs of 2007, you're about at 19% in search query volume as you were back then at the height. And so I don't have the chart pulled up now, but I looked up another chart. I looked up the internet adoption curve. So when you compare mid 2000 numbers, number of users on the internet versus today it's about 4 times. So you add that in as well. You control for that. It just becomes something incredibly ridiculous in how far we are from reaching that top that we did in 2007, just in retail interest.
Amazing. Yeah, that's quite the striking visual for sure.
Yeah. So let's go ahead and move on to the next question. This question is from Web on Web. He says, when we see inflows / outflows to the ETFs, who are these participants and why don't they just buy or sell the existing shares in the market rather than buy new shares or expire them?
I'm not exactly sure I understand the question.
I believe he's asking why
who is buying ETFs instead of individual stocks?
Why would they buy ETFs as opposed to individual shares, like individual companies, which I think you may have answered
Sure.
previously.
I mean, really, basically, ETFs are just exchange traded funds where you can sort of have an allocation as a retail investor to a quote unquote fund. So rather than like buying a private, mutual fund that's going to buy the underlying stocks, you can buy it like a stock, and it owns a basket of equities. So it's highly liquid, which is why institutions like them. But it also is just diversified exposure to something that you want to place a bet on without having to do any work to understand any of the individual companies. So it's kind of a one-stop shop. It's like, oh, I'm bullish uranium, but I don't want to do any work or subscribe to a newsletter or whatever it might be to figure out which stocks to buy. I'm just going to buy the ETFs. As far as the outstanding share count and the buying and selling, that's a little bit more complicated, but it just has to do with capital flows going in or coming out of the ETFs and how that is relative to the flows in and out of the underlying holdings. So when the flows are greater into the ETFs than into the underlying holdings, they issue shares and they raise cash and they buy more of the underlying holdings. And so you can actually look at shares outstanding and share issuance by the ETFs and recognize that money is, generally speaking, flowing into the sector. That's actually something we're seeing right now, which is really interesting because we've only had a couple of days this year so far where we've seen any outflows from any of the ETFs. Money just keeps coming in. So even though we've seen moves to the downside in these stocks on 2 occasions over the last month, money keeps flowing into the ETFs, keeps flowing in, keeps flowing in. And there's been a few occasions in the past, and this is something we track daily, by the way, is that the share counts of ETFs. There's been a few occasions in the past where the sector was very bearish sentiment and the stocks were just chopping sideways to slightly down. and we took note that money was coming into the ETFs. So we took that as one piece of evidence that we thought the smart money was actually positioning and taking the other side of that bet. And that did portend a move to the upside for the sector. Not saying that we're going to see that tomorrow because we're seeing flows come in right now, but not huge flows, but on balance, money still continues to flow into these ETFs. So yeah, and it usually happens in real time, by the way. So a day like today, where you saw what URNJ down 5.5%, 1,000%, they were redeeming shares and selling their holdings, or selling their holdings and then redeeming shares. So we're probably going to see in the next 3 to 4 days, because there's delayed reporting, that the ETFs were big sellers today. Most likely that's what happened when you see everything across the sector red.
Yeah. And if you've got buyers like institutional buyers coming in, they need liquidity. So that's why they get into the ETFs as opposed to the individual shares, bar like Cameco or Kazatomprom or NextGen. But
Yep.
yep.
Yep. We had a conversation with a fund manager last week, and he was telling us how he's been talking with a lot of other generalist funds and how they're generally gaining interest in this sector. And the sector is still so small that a lot of them can't even have a meaningful allocation to anything in the sector. But basically, they don't do a whole lot of work on the individual companies. They're not sitting down and doing discounted cash flow analysis on Paladin or any of these other large companies, right? They basically pull up their Bloomberg and they look at the top 5 most liquid stocks in the uranium space and they buy that. That's it. They go for liquidity. Doesn't matter if it's overvalued or undervalued on a relative basis to peers. They just buy what's liquid.
Yeah.
The ETFs
I mean, there's been
can't offer that. Yeah.
Yeah, I mean, there's been studies done that show that typically 5 random stocks within a given sector is usually a good approximation for that sector. Like on a I don't remember what exactly it was. I think it was like 70%, like captured 70% of the move of the sector, something like that. But a handful of stocks within a given sector will usually give you a good representation of that sector.
Interesting.
Yeah. So next question here from Paul L. He asks, what would force majeure actually mean for the spot uranium and equity prices? Can you also define what force majeure is?
So force majeure is basically, I believe it's a legal term, some reasoning to enable an entity to extract themselves from a contractual obligation. So I think what this person is talking about in this particular question is basically if a producer will tell a utility, I'm sorry, we cannot deliver that material, and use force majeure to exit that contract that is requiring them to deliver material that they promised in the past through a contract. So for example, we actually had a force majeure take place on the opposite side with a Japanese utility in Cameco. So they had signed a very high price contract in 2010. 2011 comes along, their power plant gets shut down. They don't want to pay $80 a pound to Cameco for material they're not going to use. So they actually broke out of that contract in terms of buying that material. Now, this could happen on the other end. There's certain people in the sector that are quite knowledgeable that believe this will happen, and it could potentially even happen this year. I'm not quite there, but I'm leaning in that direction. I think it depends on the entity. Not everybody is in the exact same position. Yes, all of the primary producers have been flexed up on with their previous contracts with utilities. They're all, generally speaking, in tighter shape than they ideally would be in this particular price environment. They've written a lot of contracts. There's not a lot of material in the forward curve going out 3, 4, 5 years from any of the producers. It's pretty thin. But will we actually see, a Cameco or a Kazatomprom not deliver pounds? I don't think so. I don't think we're going to see that. Are there some other entities that are in worse shape on the production side? Yes. Is it possible that we actually see a nuclear utility not receive material that they have contracted for? I think that is a possibility in this market. So what will it mean for the equities is a harder question to answer. What will it mean for the price of uranium? Obviously, it probably would have, upwards pressure on the price. And we haven't seen that yet, but something kind of in that vein that we saw last year was the South Koreans coming in with an RFP in the market. And rather than saying, we need this many pounds year over year starting in this year, They said, we need this many pounds year over year starting this year, and we're willing to pay this. And the market said, haha, I don't think so. And they had to come back to the table. Now, my understanding is finally they did actually sign that contract. Of course, the terms are not disclosed. But when the Koreans were sent back to the table this was last July, August, right after that is when we saw the price really take off. And that was a signal. That was a signal. And it was not just a signal because it was an RFP that didn't get filled. It was a signal in that a Korean RFP didn't get filled, because historically speaking, when the Koreans come into the market with an RFP and they've got their prices dictated of what they're willing to pay, you want to fulfill that RFP as a producer. The Koreans are historically just great customers, and the prices, historically speaking, that they would come in offering were reasonable for the sector to fulfill. So when that didn't happen, it was a pretty big signal to the industry. And just following that, it wasn't like, oh gosh, there's no uranium left, guys, time to panic. That's not what happened. But it was a signal that the terms that they thought they could get, nobody was willing to give them. And that was a big exclamation point in the market last year. And what followed was a big move in the price. So if we actually hear that a producer is unable to fulfill a contract, that would probably be the closest thing to a quote unquote panic moment for nuclear utilities. And it's not something I'm pulling for. It's not something I'm betting on. But judging by the dynamics that we're seeing in the market right now, I'm not saying it's entirely out of the question.
Gotcha. So let's go ahead and move on to a question from Silverbear. He asks, can someone show me a chart where the supply meets forecasted demand with details on both sides? I think it's kind of a rhetorical question, but he's essentially asking, is there any foreseeable scenario where supply actually meets demand?
Sure. I mean, I think the most plausible scenario would be demand ending up being lower than what's being projected. So that would probably be late this decade if that were to happen, because late this decade is when we expect to have increased production from Kazakhstan, when we expect to have next gen's Arrow, hopefully, Global Atomics DASA, full production out of MacArthur River, which is probably close to 25 million pounds a year. Cigar, not sure where that's going to be, moving on to phase 2 of Cigar Lake, and how much they'll be able to get out of that, we don't know yet. But that's probably the point when considering the decline rates of all of the existing mines right now are not yet going to be hitting, let's see, terminal levels. And we have new production ideally coming online. So let's say 2029. That's probably the point where if we see demand significantly less than what is being projected, we could see a balanced market for that moment in time. The curious part of that projection, or of any projection really, is that simply to make a visual graphic representation of supply and demand, you actually have to take snapshots, right? So you have to take, okay, total 2025. How many reactors will be operating? What's that total gigawatt hour capacity? How much uranium are we expecting them to consume based on some enrichment tails assumption? That's your demand picture. Then you go to the supply picture and you have to model out what mines you expect will be producing. Are there any new ones coming online? Do we expect any problems within the ones during that year, et cetera, right? You have to take a snapshot during that year to see if the market is going to be balanced or how far the deficit is during that particular year. But the industry lives 5+ years in the future. Like, that's what 2030 is what matters right now to the nuclear utilities. Sure, there are a handful of utilities, especially in the US, that are uncovered late decade still. But if you go on to the 2030s, that's where we get into the Wild West, where we don't know where the production is going to come from, because Prom and their joint venture partners are going to be able to sign some contracts in that period of time. Cameco is, Orano is, the big boys are, but the development projects have not signed a lot of contracts, if any at all, depending on the project. So NextGen hasn't signed any contracts. Global Atomics only signed a few. The other potentially larger projects in Namibia, my understanding is these folks, the Bannermans and the Deep Yellows and the Forces, and they haven't signed contracts. So there's a lot of questionable production late decade into the early 2030s that has not yet fulfilled any contractual obligations for nuclear utilities. So even though we can see a balanced market in any given year, that doesn't necessarily mean anything in terms of how much buying anyone will be doing around that period of time. By the time we get to 2029, they're buying for 2040, 2045. We're already hearing there's contracts going into the 2040s for uranium and for enrichment, and even for conversion is going out into the 2040s. Not all the contracts, but they're starting, some of the long-term ones are starting to get there.
Okay, next one from Silver Smurf. He asks, what is your exit strategy? What are some things you look at when determining it's time to get out?
I'm grinning because I'm liking all the silver names. There was Silverbear and now Silver Smurf.
Yeah.
Which, by the way, go silver, please.
Any day now.
Yeah, I know. It's, what, that's one market, just as a side note, I think that there's enough long-term pain for precious metals mining stock investors that when that market finally turns, that's going to be a pretty roaring market.
Yeah.
When it finally goes, and it will go. I don't know when. I expected it a lot sooner than where we are today, but
the spring's been coiling for quite some time.
yes, it's a very coiled spring, especially for the mining stocks. Anywho, what's my exit strategy? Generally speaking, I would say that you're going to want to take chips off the table on the way up incrementally. I think reducing position size by small percentages over multiple tranches of selling is the smartest way to do it and the most psychologically easy way to do it. I think trying to take full positions off and expecting to hit the actual top is basically impossible and extremely stress inducing. So that's not my style. So he's asking me personally, I'll be peeling off on the way up, and I will be paying very keen attention to the physical uranium market more than anything. Like we talked about earlier, the fever pitch of bears in markets in general have had people out of the markets. If I was convinced we were going to see a broad market crash over the past 18 months, I wouldn't have been invested in the sector that has given me positive returns during that period of time, or multiple sectors which have during that period of time. So I'm not saying I ignore economic numbers or the movement of the broad market. I don't. But focusing on this market is number one importance, and especially the physical market. So we are going to want to look for evidence of increased liquidity in the spot market. We are going to want to look for evidence of hedge funds, financial entities, selling into the spot market, and potentially for that selling to be motivated. So whatever that looks like, at whatever price that happens, I don't know where that's going to be, what price level, or when it's going to happen, but it will happen. And that's probably going to be a pretty good sign to take whatever chips are remaining on the table off, at least for the time being, until we see that settle out. So that could look like a lot of different things. I think when we lead up to a point where big projects are about to come online, so for example, when we hear announcements that NextGen is going to have first cake in the can, in 12 months time, probably time to start to recognize and look for signals in the market of expectations of that supply. So those are all things that we look for. It's hard to say that it's going to be X, Y, or Z that's going to be the actual catalyst for selling out, but most of the time with these sort of very volatile long-term bull and bear markets, you're going to want to act before the crowd. You're going to want to protect your capital, pay yourself on the way up, try not to hold full positions, try not to time the absolute very tippy top of the market because it's going to be very difficult. And then hugely important is having access to information where you can know what's happening in the physical market. There's my shameless pitch for a newsletter, because that's literally what we focus on more than anything, is looking for that evidence. That's also what has kept us in this trade more than anything, is speaking with people who are buying and selling the stuff and saying, hey, what's going on here? Who's selling and why? Who's buying and why? where are we headed? And we always have our finger on that pulse. So that's how we know when we're going to eventually get out of this trade, at least for the time being. With all of that said, things now look extremely constructive for nuclear energy. This could be one of those major super cycles that lasts decades. Now, that doesn't mean that the uranium price goes up in a straight line for decades. It won't. Eventually, high prices will cure high prices. We will see supply eventually respond. But I think we have a long ways to go to the upside. I honestly think that's probably north of $200 a pound, and it's going to have to stick at those prices in order to incentivize some innovation in the sector, not only on the mining side, but potentially with other means of extracting uranium, whether that's seawater or phosphates. I don't really know where it's going to come from, but high prices will bring supply eventually. It's just we have this unique moment in time where the price could be $500 tomorrow, and it's not going to make next gen's Arrow, Global Atomics, DASA, Kazatomprom's ramp happen any sooner. It's just not. It takes time for this supply to respond, and so that's where we're at now. We've got multiple years of that.
Yeah, yeah, and I hope you you don't mind me piling on to your pitch there, but I mean, you guys are the only 100% focused uranium newsletter in the business. While there may be other newsletters that look at commodities, you know, uranium might be a piece of that service. Their research is spread out across a number of different things, but you guys are all focused into uranium. You look at this stuff day in, day out. The way I like to put it is that I view you as like my personal analyst. You know, I commission you to go do all this research, and then you write your newsletters, you do your webinars, and then I can decide as a CEO of my portfolio what to do from there. But that's the way I kind of view, you know, you guys. You know, I have other things that I do. I don't have time to do the in-depth research that you guys offer, so that's where you come in. Let's go ahead and ask one more question if you have time here, Justin. Are you still good for one more question?
Yeah, of course.
Yep. So next question is from Ren Skate. He says, what is your opinion on the spot market, low share versus LT market share that Rick Rule has pointed at, and what it means for the character of the rest of the uranium bull run? Does it change the overall picture of an overshoot, pullback, and normalization?
So I guess I'm going to assume he's talking about the actual reported long-term price.
Mm-hmm.
Is that your interpretation as well?
Yeah, I think so.
The long-term price at this point is basically a throwaway number. It's practically irrelevant. It's so essentially what the long-term price is right now is during any given month, and it's only reported at the end of the month. During any given month, it is the low offer in the term market. And the term market is anything beyond 12 months settlement. So it could be 13 months settlement, you know, 100,000 pounds. That could be the low offer. But the long-term price here is what is it, $66, $67? It's absolutely absurd. What I believe this price is at this point, this reported price is the floor in a contract negotiation during that month in the term market. So if you have a market reference contract that you're negotiating as a producer, and you might have a floor in the high 60s or low 70s with a ceiling at $120 or something like that, right? That's what I think that price is, but it's utterly irrelevant. At this point, it's not even a starting point for discussion in terms of pricing in term contracts. So it's become basically kind of a joke. That long-term price that's printed by UXC is a joke. So what you can look at is the 3-year forward, the 5-year forward price, which gives you more of kind of a futures priced in. And that at this point is substantially higher than the existing spot price. And so that is a more accurate, quote unquote, long-term price. I'm not sure if I answered that correctly or justly, if I got that question straight.
No,
Do you think?
I think that was pretty much it. I think he may also be alluding to the fact that the spot price has run away from the long-term price, which was an indicator of last bull market that you had reached a top.
Right, exactly. Yeah. Yes, that was a big indicator to see that market severely backwardate. But so right now, okay, so to give you an actual tangible example, when we saw Sprott buying in heavy volume, let's say September, October of 2021, during that period of time, Spot price jumped up $10, $15 above the term price. At that time, in the term market, especially in a 2, 3, 4 year type forward curve, you actually could secure contracts at those prices. So that term price was far more accurate in terms of actually what is being done in contracts for those time periods. So that was a backwardated market. And there was clear evidence of that because what happened? Traders that had forward commitments, so carry traders that had forward commitments to utilities, holding pounds on their books that were to be delivered to the utility in the next year or 2 or 3, sold those pounds that were committed to Sprott and went back and covered on the midterm in the term market at $10 lower per pound. And that was the reverse carry trade. And that provided liquidity to Sprott during those 2 periods where they did a lot of buying. Probably 10, 15 plus million pounds was shaken out of the carry trade. That also tightened up the midterm because those guys had to cover in the midterm. That was an actual backwardated market. Now, I would argue, now it's hard to even tell what is backwardation and what is contango in this market because the forward curve is so incredibly tight. You couldn't sell pounds right now at $102 a pound in the spot market and cover anywhere going forward at a lower price. That can't happen. That won't happen. And why? Well, we look at the 3-year forward, 5-year forward, UXC, month end prices. Okay, so this is January month end still because February still has another week and a half to go. Long-term price, $72 a pound. Spot, $100 a pound. 3-year forward, 107. 5-year forward, 113. So the 3-year forward and 5-year forward, if those are higher, then we're still in a contango, essentially. And that's kind of where we're at right now. So these markets are all connected. It's not like the spot market is like this entirely different market. It's just the terms of settlement. You'll see RFPs go out into the general market, and depending on whether or not the deliveries or the settlements on those RFPs are within 12 months or outside of 12 months, that's what determines whether it's spot or term. Of course, term contracts, generally speaking, are much longer. They go out much further into the future. But the markets are absolutely linked.
Gotcha. Well, that's all I got for questions. I want to be respectful of your time here, Justin. Any closing thoughts before we wrap this thing up? Fantastic as always, Justin. Always glad to have you on the show. And if you enjoyed this content, be sure to give it a like. Subscribe to the channel if you haven't. Comment down below. Let me know what you think of any of Justin's points. Do you agree or do you disagree? And if you want to support the channel, you can always buy me a coffee. Link is down below. Or you could subscribe to Uranium Insider, Justin Huhn's newsletter. We are an affiliate to Uranium Insider, so we do get a cut That's one way to support both me and Justin. And I think that's it, you guys. I'll see you in the next video. Bye, y'all.